Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And so let's get into today's episode. So last week I spoke about and compared, in fact, investing in property in personal name versus investing in super, on the basis that, one of the major attractions in people's mind is with investing in property in super is if you hold that property until you reach retirement, then convert your superannuation fund into pension phase, you're not going to pay any capital gains tax. Of course, if member balances are under the transfer balance cap, which is 1.9 per person at the moment, increasing to $2 million on 1 July this year. So, there's always exceptions and rules with everything associated with super. It's never just that simple. And then I took the episode one step further and then thought about, in fact, the conclusion was that the benefits arising from avoiding capital gains tax were equally offset by the negatives associated with less negative gearing benefits, just because it's a lower tax environment, so your tax savings are lower, together with the interest rate premium, about 1%, loans to self-managed super funds at higher interest rates than that in personal name. So those three factors, I should say, net each other out. So the tax benefits aren't that attractive. And so I took it one step further and said, well, should you still use the gearing? Because the gearing is, kind of the effective sort of strategy tool, albeit at a lower loan to value ratio. And, it could be appropriate in some people's circumstances, but just generally, most people will be better off keeping their situation relatively simple and therefore not needing to have a self-managed super fund or deal with all the complexity associated with a limited recourse borrowing arrangement. And that was the general conclusion of that episode, which is last week's episode. So if you missed that, feel free to obviously go back and have a listen to it. Anyway, last week's episode was like a good segue into this week's episode. And this week's episode is an idea I've been mulling over for a few months that would appeal to people that are asset rich but cash flow poor. So that is that they would like to invest in property in their personal names, but either because of the cash flow consequence of it, in terms of a negatively geared property, particularly investment grade property, costing so much to hold, particularly while interest rate settings are relatively high, or if in the situation where people's borrowing capacity is compressed, they can't really borrow enough money to get the level of quality of property that they really want or desire, this strategy could be appropriate for them. Now, I speak about quality a lot in this podcast. That is, the quality of your assets will determine or have a great influence on your future returns, and that you can't expect great long-term returns from an average quality asset. Now, in the short term, asset quality might have less of an impact. So sentiment, timing, be in the right place at the right time, which is not really an investment strategy, of course. These sorts of things can have an impact, in the short term. COVID, for example, anyone that bought a property in a regional location, say in early 2020 before COVID hit or late 19, would have just been in the right place at the right time and done incredibly well. Now, that's fantastic. But remember, the secret to investing in property is to have the highest average compounding capital growth rate over the ownership period. And so if my ownership period is 20 plus years, I want to invest in a location that's going to give me an average rate of 8% over 20 years, and not just 12% over the first 5 years and then it levels off. Because then if it does that, your average rate is going to be much less than 8%. So that's kind of the goal with property investing. And to increase the probability of that occurring, you really need to invest in a location that is always going to benefit from excessive demand. So that is, demand for property in that location exceeds the supply of property, and that the people that demand that property have multiple sources of wealth in order to be able to continue to pay more. So you don't want their capacity linked solely to household income, for instance, because if household income's only rising by 4% per annum, or maybe not even that in some situations, then their capacity to be able to pay more and more and more for that property is quite limited, right? So that's the thesis that I, speak quite a lot about in this podcast. So therefore, we've got to then think very, very carefully. If we're going to go and invest in property, we've got to think very carefully, what will this property be worth in 10 years and what will it be worth in 20 years? And that can be a really difficult mental leap to make, particularly if you don't have a lot of experience in owning and investing in property. But I guess talk to anyone in their 60s or 70s, they'll be able to tell you heaps of stories about, well, I bought this property for X and now it's 10 times X or 20 times X. They could have never anticipated that would be the case, and it's difficult to get head around. So the key assumption that I'm going to base today's strategy on, that I'm going to share with you in a minute, the key assumption is that if I get to extend my budget, I get to invest in a higher quality property. So for instance, in Melbourne, if your budget was less than $900,000, it's going to be difficult to buy a house in a well-established blue chip suburb that's going to be investment grade. Now, it's not impossible, but you're going to have to make some compromises. To what extent those compromises look like and what impact will they have on the capital growth rate, that's another podcast for another day, but you will make some compromises. However, if you could extend your budget to say 1.2, you've got a greater chance of securing an investment grade property. And by doing so, you're leveling up on quality. To my mind, you're positioning yourself to enjoy a higher average compounding capital growth rate over the ownership period. And you're also reducing your investment risk because you've got a better quality asset. So the probability of that investment working for you in the long run is much higher than, say, an average quality property. So this is a key assumption, and you need to think about, when I share this co-investing strategy in a second, you need to think about it in your circumstances. So where are you investing? What budget do you have? And if you could extend your budget by to 300,000, whatever it might be, what does that look like? What does that look like in terms of the target property and its attributes and its probability and historic growth? So we look for the evidence. What does that look like compared to, not doing a co-investing strategy and having a lower budget? You need to make that assessment, because the only reason you do the co-investing within super is to be able to level up on quality and get a much better asset. And then ultimately at a portfolio level, so we're not just talking about super or personal name, but we're talking about your entire sort of family wealth perspective. As a result of leveling up on quality, you're going to put yourself in a much better position. And that's a really important point. This strategy isn't about tax benefits. It's not about anything else other than trying to extend your budget to improve quality. I'm harping on now, but I think I've probably made that point. So how do you co-invest with your super? So the first thing is you need to have plenty of equity in property outside of super to be able to borrow against. Because essentially co-investing with your super means that you're going to go and buy a property. That property is owned tenants in common, and you will own a portion individually or in both spouses' names, whatever it could be, and your super fund will own a portion of that property. The thing is, though, and tenants in common is different from joint tenants. So just for those people that aren't aware, that's the two ways you can own property. Joint tenants is that there's multiple people that own a property. There's no discernible ownership percentage, and they're just assumed to own it in equal shares. So if you've got 3 people on title, each person has a 1/3 equity ownership in that property. Whereas tenants in common is different. You can ascribe an ownership percentage to a particular owner. So for example, I might own 20% and my wife might own 80%, but you can play around with those ownership percentages when you first buy that property, or even down the track if of course, it's going to trigger stamp duty and capital gains tax, so you wouldn't necessarily do that. But that's the difference between tenants in common and joint tenants. Okay, so let me use an example to explain how you'd co-invest with super. Let's use the example of buying a property for $1.2 million. And let's ignore, for the sake of this example, ignore costs. So stamp duty, buyer's agent fees, those sorts of things. Let's say you're going to use $300,000 from your super, and then you're going to borrow the rest. So that means your super fund's going to own 25% of the property, and then the individual investor would need to go and borrow the remaining $900,000 to purchase the property. But because that property, part of that property, 25% is owned by the super fund, that property cannot have a loan against it. So essentially what the investor would have to do is they'd have to borrow that $900,000 against equity in other property. And this is why it's a very sort of particular strategy. It's not going to suit everyone, but certainly for people that are asset rich, income poor, it could be a great strategy. That $900,000 loan could be secured by a home, it could be another investment property, whatever it might be, that doesn't really matter. And the interest on that loan, because there's a direct connection with buying an investment property, the interest on that loan will be tax deductible. So the security related to a loan has no impact on its tax deductibility. It's all around the loan purpose. So what that loan was actually used for when it was first set up. Okay, so just to recap, we've gone and borrowed $900,000, let's say against the family home. We've taken $300,000 out of super, or not out of super. We're using $300,000 that's inside a self-managed super fund. Together, we've got $1.2 million. We go and buy an investment property. For simplicity, the best way then to set it up would be to have a joint bank account that would be in joint names with the self-managed super fund and the individual that owns the 75%, or individuals that own the 75% of that property. And all income and expenses would flow through that account. So of course, there's no debt against the property, in that joint account. So there's no loan repayments coming out. It's really just interest, less property expenses. So it's really just the net income from the property manager, really. And then as money accumulates in that account, you would then distribute it. So 25% would go into the super fund and 75% into the investor's name. Separate to that, of course, the investor needs to make the loan repayments on their loan. But essentially, the investor in personal names has 100% gearing. So they're going to get all the gearing benefits, but essentially have no gearing inside the self-managed super fund. Okay, so let's talk about the pros and cons of this idea, because of course every strategy has some benefits and some potential downsides. So firstly, and I think, I really want to make this point very well, or very clear, the reason for implementing this strategy is to extend your capacity to be able to invest in a better quality asset. And the thesis is that higher quality asset, of course, then will generate better returns. So it's not really around tax benefits, gearing strategies, any of that sort of stuff. I'll talk about the pros and cons in a second, because there are some pros and cons associated with that. It's really, that's the key idea around the strategy. And I think this strategy, as I said, will suit a lot of people, particularly in a high interest rate environment where borrowing capacity has been compressed over the years. It'll suit people that, are really asset rich and cash flow poor, because it means that I can go and buy a $1.2 million property, but have a lower overall gearing rate just because I'm using some of my super to help me in terms of my capacity. So what are the other benefits beyond this main benefit? And I'm almost loath to mention the other benefits because I don't want to water down the fact that that's the primary reason for doing it, but there are some other benefits. And of course, the other benefit is whatever share is owned inside the self-managed super fund, if it's sold after you enter into retirement and your super fund is fully in pension phase, then of course you get to avoid the capital gains tax on that share, that portion of the asset. It's an effective way to hold an asset that's not fully geared. So in the situation where, you actually had some monies outside of super, in fact, taking those monies, making a non-concessional contribution inside super and co-owning it inside the self-managed super fund is a good way to kind of split an asset that isn't fully geared. And so you have the ungeared portion then in a self-managed super fund, which is a lower tax environment. You're only going to pay 15% tax on the rental income and potentially nil on the capital gains. And then if you're going to have gearing against the asset, have it fully in an individual's names, assuming that an individual has other income they can offset the rental loss against and therefore generate better negative gearing benefits. So it is a very efficient structure from a gearing perspective if you're going to have an asset that's not fully geared. One of the downsides to borrowing to invest in property, as I spoke about last week, inside super is that, it eats up a lot of the cash inside super. It eats up the cash flow and retards people's ability then to build diversification in the fund and build liquidity and all those sorts of things. Of course, this situation The super fund is ungeared, it doesn't have any gearing, and so it's going to have the positive cash flow from the property, and that cash flow can then be reinvested in other assets like the share market. And it is a better way then to avoid that liquidity trap that I sort of spoke about last week. So they're the main advantages. Now, of course, there are some disadvantages too, which we must be aware of and cognizant of. Firstly, it introduces a lot of complexity. And again, you want to make sure that complexity is justified, which is why I sort of spoke about a few minutes ago about making sure that this is actually going to help you level up in quality. But, firstly, you need to have a self-managed super fund. So there's no other sort of superstructure that's going to allow you to sort of co-own a direct residential property. And so you certainly need to understand the costs, obligations, and complexities involved in having and running your own self-managed super fund. And secondly, the complexity around having a property that's co-owned with super means you're going to have to be really careful about how you manage all the expenses and income and expenses associated with that property. Remember, having a dedicated joint bank account to just quarantine the income coming from that asset would be wise to do. Maybe even just making distributions out of that bank account once a year after the accountant has done all the tax work for that for you individually and for the super fund to make sure you don't make any mistakes. But of course, it's more complex than, say, owning a property 100% in personal names. The other thing too is if the property needs some capital improvements or maintenance down the track, of course, the investors are going to need to contribute proportionally to that. So going back to my original example, if I needed to put a new kitchen and bathroom in the property and it was going to cost me $100,000, well, of course, the super fund needs to contribute 25 and the investor outside super needs to contribute $75,000. And it's just important that they will need to make sure that they maintain those contribution ratios throughout the ownership of the property. And you need to think about that, making sure you're in the right position to be able to accommodate that. And the other downside is you don't have a fully geared property, at a total portfolio level. You're putting cash into the asset. One of the main attractions and one of the reasons, and hopefully this is obvious by now, that investing in property, borrowing to invest in property is such a powerful strategy, is that from an internal rate of return perspective, you can go and buy an asset, and if you have equity in other property, you don't need to contribute 1 cent towards that asset. All you've got to do is contribute the holding costs, and that's really your capital that you're putting into the investment. In this situation, in the example, we've contributed 25% of our own cash. So we've got a lot lower gearing rate there, and that's going to then mean overall lower returns. Now, again, you hope that that's offset by the fact that you've leveled up on quality. And again, I keep harping on about this, but this is the key reason for considering this strategy. And if that's true, then you're probably going to be better off. But if it actually doesn't help you level up in quality, then all you've done is got a asset that's has some lazy gearing in it, if you like, and you'd be better off not doing that. And so gearing to less than 100%, of course, is going to be mathematically less effectual if we hold the returns equal between those two scenarios. Now, while this is an idea to co-invest in your super and it could work for some people, I'm always really careful about not trying to fit a square peg into a round hole. Sometimes I think people are overly focused on investing in property, and the reverse is true for a lot of financial advisors. Sometimes they're overly focused on investing in super or the share market, and I think that's dangerous. I think if we need to create a solution that is overly complex or convoluted just to make it work, then I think we should really consider whether investing in property is the right choice for you. When formulating a financial strategy, we certainly do, and my advice to you would be to do the same thing, is be completely agnostic between property and shares. Approach the challenge of developing a financial strategy with a very open mind, because obviously the goal is to find the right strategy that's really the right mix of asset classes and assets to help you best achieve your financial and lifestyle goals in the simplest and most cost-effective manner. That's the overarching strategy. So sometimes if people become too fixated on property or any asset class for that matter, it can work against them and they don't end up finding the right combination of assets. And they, instead of having a simple strategy, they're a complex one, and instead of having a low-cost strategy, they've got a high cost strategy. And so I think that's really important. And lastly, if you are going to consider implementing this strategy, look, it's important because of its complexity and because of its uniqueness, I guess, important you get some independent advice. And really that's advice from someone that doesn't have anything to sell you, doesn't have an investment to sell you. And so be careful, going in and asking, what does Warren Buffett says? He says, asking a barber if you need a haircut is a stupid question. It's the same sort of thing if, you go to a property-based firm and said, I've got this idea, do you think I should do it? What do you think their answer is going to be? So make sure you get some really good professional advice, particularly if you're going to introduce complexity to your financial situation. It's important it's done really well. All right, let's get into some listener questions. First one is from Emmanuel. Thank you for a very informative podcast. I'm probably one of your first listeners. Well, thanks, Emmanuel. Thanks for hanging in there. Hopefully it's improving each year. I hope that's the case. I certainly try to think a lot about it and put a lot of energy into it. I hope you'll be able to answer and make sense of my long-winded question. Actually, Emmanuel, looking at your question, it's not that long-winded. I've sometimes get questions that run over multiple pages. Anyway, I have a property in my self-managed super fund. I'm currently paying the interest in addition to making my mandated fortnightly repayments. I think Emmanuel's saying he's paying principal and interest. If I continue doing this, I'll be able to pay off the loan in 10 years, which is the time I intend to retire at 66. The repayments are around $2,500 a fortnight. The interest is around $4,000 a month. My question is whether it would make sense to put the $4,000 a month into an ETF. My interest is around 7%. The reason I'm paying principal and interest is to get back at the bank and pay them less interest as opposed to paying them a lot of interest over 20 years. However, I'm wondering whether I should set aside my emotional decision based on trying to win against the bank and whether letting them get my 20 years of interest and putting the $4,000 into another investment is a better idea. I'm not worried about diversification as I will sell the house in 10 years when I retire. In summary, would I be better off investing $4,000 a month or paying off the mortgage? It is a great question, Emmanuel, and really well timed, actually. Certainly not by my design, because obviously the last couple of weeks I've been talking about property inside super. So, the thing you need to think about, Emmanuel needs to think about, is his time horizon. He says he's going to sell the property in 10 years. He also says he's going to retire in 10 years' time, that's the first thing, right, I'd be thinking about is when we get into retirement, are we going to be able to repay a pension? Because in a situation where someone is so focused on debt repayment, and if all the cash flow is going to go towards debt repayment, then you'll end up with a relatively illiquid asset that hopefully is worth a lot of money, but the net income relative to the asset value might be a lot less. You've got to take 4% out a year when you first enter into a pension. If you're between ages of 60 and 65, you're probably not going to get a 4% net rental yield, so after all property expenses. And so it's not going to have enough cash flow to be able to pay a pension, and that's a problem. Now, Emmanuel says that's fine because I'm going to sell the property after I retire. My concern then is, well, what happens if at that time it's not the right time to sell? So, for example, if that was today and that property was in Melbourne, it would be a shame to sell in this market as opposed to maybe hanging out for another 2 or 3 years. When the market really kicks off, chances are you're going to realize more value. And so you want to have that flexibility. What Emmanuel is suggesting is a bit of a black or white decision. Do I go back to repaying interest only and then invest the $4,000 a month in ETFs? Maybe there's some balance to be made there. Maybe what you should do is go back to interest only, have an offset account, maybe consider putting $2,000 a month into that offset account, which is still going to help you save interest, and put $2,000 a month into the share market. At least that will allow you to build a pool of liquid assets that will then help you convert your super fund into pension phase, pay the minimum pension so that you've got a compliant super fund, but give you some flexibility around when you might want to divest of that property. So I think putting all the money into the loan, paying it down to zero and having a liquid asset and being forced to sell at that 10-year period, I think I would want to avoid doing that. Would you put all the $4,000 into the share market? Well, markets are pretty high at the moment. Maybe start with $2,000 a month. And if the market was to crash or correct, maybe you dial it up to $4,000 a month. I don't know, but it's a great question, Emmanuel. It's one of these things that Campbell's spoken about previously over the Christmas break around the liquidity trap, and really the last couple of weeks talking about really planning in regards to this. It's an important example of how you can benefit from advice because, as I said, we've had plenty of clients in situations like this, and we get to share those stories with other people, particularly through this podcast. Okay, next question is for Oliver. Oliver shares some nice feedback about the podcast. Thanks so much, Oliver. Oliver writes, I've heard it been long touted that as long as you have a non-tax deductible debt, so a home loan, it's always better to repay interest only on all other investment loans and use the extra cash flow to repay the home loan as fast as possible. In principle, this made sense to me, but my wife modelled this for the first 5 years and showed me that our net position would be worse off than having both loans P&I. I'm assuming this is due to the differential in the typical interest rate, that interest-only investment versus P&I home loan, because the investment loan's about 0.5% higher is what Oliver's suggesting here. Or is it if you continue this trajectory out longer, say 15, 20 years, the position would switch and the strategy is valid? Or is it all based off your investment debt as the proportion of your overall debt, as referenced in your article? And he gives me a link to my article. We feel we fall into this rule of thumb as the investment debt is a bit over 50% of our overall debt, so we should put both into P&I. And then Oliver goes on to sort of talk about, the other benefit is you free up more cash flow, acquire more assets, but he suggests that they don't really need to do in their position. So I won't go further into Oliver's question, is not particularly relevant to the answer because it is a really good question. I suspect Oliver's wife hasn't included the tax deductibility of the debt. So let's think about this, right? If you've got a home loan, let's say it's 6.5%, the interest rate. Well, that's non-tax deductible debt. So your after-tax cost of that loan is 6.5%. And if you repay interest only on that debt, your interest rate's probably 0.5% higher, right? But let's not confuse it. That's principal interest home loan, 6.5% after tax. If we say the investment loan costs you 0.5% more, so 7%, the difference is you get a tax deduction for that interest, right? So, and if you're in the highest marginal tax rate, so that is you're paying 47%, that means the after-tax cost of that 7% interest, so if you say 7% less the 47% tax deduction, gives you a cost of 3.71%. So that's your after-tax cost of debt for the investment loan. So it's really 3.7% versus 6.5%. You always repay the most expensive debt first. And it's the tax deductibility that makes that debt more expensive. So for you to be better off to equalize repayments, essentially the investment loan interest rate would have to be well over 10% for the after-tax cost of debt to be more than 6.5%. And so therefore, what we should do is structure our debt so that all our spare cash flow goes into the highest costing debt first. And then after that is fully repaid, then we then think about what is the best use of cash flow. And so that's why it's better to have the home loan on principal interest. Certainly interest-only home loans attract too much of a premium these days. So on principal interest, and have the investment loans on interest only. If you have a lot of cash flow, and if your home loan is already very low and you expect to repay it pretty soon, you might have all the loans on principal and interest. But if your home loan is sizable and it's going to take a few years to repay it, I think you're better off having the investment loan on interest only and repaying principal interest on the home loan. So a great question, Oliver. And it's good to do these calculations, right? And it's good to ask the questions. So thank you very much for sharing that, because other people are going to be thinking the same sort of thing. And if they don't do the right calculation, they miss the tax deductibility of debt. Certainly you're going to reach that conclusion that your wife did, although it's not quite correct. Next question that was submitted by John talks about his mother passed away. He has a 25% entitlement to her estate. which we'll realise between $1 to $1.5 million. John has super, which is really includes a commercial property and a loan, and then some shares. The balance is about 800. Net balance is about 100,000 in super. 3 investment properties in personal name, and then 1 in a property investment trust, a Chan and Naylor hybrid trust there. So really 4 properties outside super, if you like. He's going to use some of those funds to repay the loan in the trust so that he can use the carry forward losses. That makes sense. Add a maximum non-concessional contributions into super, and then put the rest of the money into the offset account. But the problem with John's question is there's no question. I'm going to assume what John meant to write is what do I think about that in terms of a strategy. So really, what John's trying to do is optimize the gearing that is outside super. So having gearing inside the trust doesn't make sense because it's going to crystallize losses, and those losses are trapped inside the trust. I just don't like those trusts. I don't like that arrangement. I never have. Not many people do. Just be really careful about being sold a product. Accountants shouldn't be selling products. If I've got a special trust deed that is not like any other trust deed out there, that's a red flag, right? People just be careful of that. That's a business model. That's not helping people necessarily. I'm not saying every situation it spells trouble, but it is a bit of a red flag. But so I like that idea. You may as well fix that problem, which is the negative cash flow trapped inside the trust. Putting money inside super, well, John doesn't really tell me his age, but let's assume that that's a good idea, especially given his balance is 800, so certainly well under the transfer balance cap, which is the tax-free amount. And then if he's got 3 other properties, you may as well put the money in the offset account. It's going to save 6.5% in terms of interest, which is a risk-free saving. And I would argue John's got enough assets. So let's assume those 4 properties, outside super are good properties that are performing well and will continue to perform well. And he's got 800,000 super, soon to be 1.2 or north of that. I don't think he needs to make more investments. I think it's really just about optimizing. But I've made an assumption there that that's what John wanted to learn, which is fine. All right, I'm conscious I don't want to make these episodes too long, so I'll leave it there. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.